My name is Sree, and I will be talking to you about the Scottish Oriental Smaller Companies Trust, which is an investment trust that is focused on investing in Asian smaller companies. You might have seen our article, Elephants Can't Gallop, recently in Shares Magazine. Now, today, I will talk to you about what to expect from Scottish Oriental. And this is primarily in terms of three areas. Firstly, the investment philosophy of the trust. Sorry, let me just get the slides right. Yes, so three areas. Firstly, the investment philosophy of the trust, which has remained unchanged since it was launched in 1995. Secondly, the kind of outcomes that this philosophy and process has driven over the long term. And finally, the positioning of the portfolio today, including an example of a portfolio company. And I'll conclude with that, and then we can go into questions. Now, starting with the investment philosophy. Now, what you see here is how the investment philosophy of the trust was first laid out in the first annual report that was published in 1996. It hasn't changed since then. The key tenets of this investment philosophy are, now, firstly, in Asian smaller companies, there is always a lot of growth to be had, whether that comes from sports shoes being sold in China or cars being sold in India. But in our experience, the difference that is made is by those companies which try to capture this growth in a conservative way. In terms of conservatism, what I mean is their attitude towards risk. We believe that the eventual leaders are those which come out stronger from every period of disruption, like we've seen with COVID recently. So our focus is always on assessing downside rather than just trying to maximize the upside from an investment. Secondly, our investment process is entirely bottom-up in nature. So our teams spend all our times being on the ground, meeting companies. So I was in Jakarta last week. I'm meeting companies in Hong Kong this week. The point of this process is to find the best investment ideas on a bottom-up basis, rather than to try and figure out which are the best themes or which are the best countries or sectors to invest in. The sector or country weightings are entirely a residual outcome of this bottom-up stock selection. And naturally, because of this process of stock selection, what we end up with in terms of weights has no resemblance or no bearing to what already exists in any index, whether that's the small cap or the large cap index in Asia. Finally, we believe the point of owning smaller companies is to own those businesses which have the potential to become the large caps of the future. These are market leaders which have dominant market positions in their categories. And as those categories grow, we expect these companies to capture the largest share of the growth that takes place. I will give you an example of this in the slides to come. But to start with, let me give you some more detail about what we mean when we talk about our approach to risk. For us, the clarity is in terms of what we will not do. For many of our peers, that may mean staying away from certain sectors, whether that's defense, gambling, or tobacco. I think that's the easy part. For our team, that means investing behind certain people and staying away from certain others, particularly in the Asian smaller company context, where a number of businesses are family-owned companies. We spend all our time trying to identify which are the families who we can back as minority shareholders over the long term, and which are the ones we want to stay away from. We don't believe that there is a price for every business. There are some cases where a family or an entrepreneur has built the business in a way which has not been fair to all stakeholders. And irrespective of how attractive the growth might be or how cheap the valuations might be, we wouldn't invest behind that. That might be an Indian tycoon that recently you've seen in the news, or an over-leveraged Chinese property company. It does not mean that every business has a value in our view. Secondly, as I mentioned earlier, we spend all our time on the ground meeting companies. And in each meeting, what we are essentially doing is trying to identify or assess what the attitude towards risk of a management team is. Now here I've pasted a conclusion from one of our meetings with a telecom tower business in Indonesia. The net debt to equity here was 10x or 1000%. And it was only a matter of time that when interest rates normalize as they have recently, this company is going to face a very difficult time. it isn't a surprise to us that that is the case right now. And finally, given our business originated in Scotland, we've always been very careful of the kind of valuations we want to pay for businesses. So you typically find us staying away from IPOs or initial public offerings. And it's in times of euphoria that we have seen a number of cycles, and we're sort of careful enough to stay away from those. So we don't try to maximize our upside in periods of euphoria. We've seen enough cycles to know that usually each of these periods ends in tears. Now, moving on to our approach towards ESG. Now, this isn't a box ticking exercise that we look at in addition to our investment process or philosophy. In fact, it is integrated into the way we look at companies or our assessment of risk. So one nuance that I'd like to highlight here in particular in relation to Asian smaller companies is that we find that most smaller companies in Asia have the right intention in terms of ESG, but very often they aren't exposed to industry or global best practices in these areas. So we believe that that's a role that we can play as investors, where we can introduce them to best practices. I'll give you an example of this. So Century Pacific Food in the Philippines is one such company that we have been invested in for about 8 years now. Now with this company, over time, as we do with each of our investments, we have engaged with them on a number of issues. So for example, we introduced them to a biodegradable plastic packaging company. It was founded in Imperial College in the UK. And currently they're doing a pilot with them. Secondly, because it's a business that is related to manufacturing canned goods, so tuna and meat, the fisheries industry in particular to which it belongs, that has a lot of modern slavery risks. So we've introduced them to domain experts in that area as well, that are working with them to create the guidelines that are required to run the business in a safe manner for all stakeholders involved. And finally, the management of the company recently acquired a brand that previously belonged to the family which has a majority stake in the business. Before making that acquisition, they actually consulted us as shareholders on what fair valuations should be and what our view is on this related party transaction that they're doing. We gave them our views, and after that feedback that they got from us, they actually they took that on board, and the valuations on which the transaction eventually happened were very fair to all shareholders involved. What we see with each of these engagements is actually the attitude of management as well, whether they are being receptive to external stakeholders and their views, or whether they disregard these views. And that gives us a sense also of what their attitude towards dealing with longer term risks are. We don't believe there is ever a perfect company. What we're always trying to see with these engagements is the direction of travel of that business. In the case of Century Pacific, each of these engagements has actually given us more conviction in the management's approach towards dealing with various risks that may emerge with the business in the long term. Now, what does all this mean, this focus on risk in terms of outcomes? Now, what you will see has been consistent since inception. So as I mentioned, it is not in periods of euphoria that we chase upside. Therefore, in up markets, we typically don't do as well as the underlying index. But because of our focus on risk, it is in down markets that we perform significantly better, typically. So since inception in down periods, we have performed better than the index almost 80% of the time. And this is what helps us do better across all market periods. And this is something that is consistent over the last 5 years, as it has been since the inception of the trust. Now, moving on, I'll talk to you briefly about one company to give you a flavor of what this investment process and philosophy means in action. Now, in our view, as I mentioned, the entire point of owning smaller companies is to have those businesses in the portfolio which actually have the potential to become the large caps of the future. One such company is Blue Star Limited, which is a leading manufacturer of air conditioners in India. It was founded 80 years ago by the Advani family, which is still the majority shareholder of the business based in India. Now, firstly, the air conditioning industry in India itself is at a very nascent stage. India sells 5 million air conditioners a year compared to 70 million air conditioners a year in China. Both countries have very similar climates. In fact, India probably is a bit warmer than China. What is interesting is that in recent years, India has reached the levels of per capita income where we typically see an inflection point with regard to the air conditioner category. And therefore, sales of the whole category have been growing much faster in recent years at more than 15% a year for the last 3 or 4 years. This is much faster than it was over the last decade, where per capita incomes were not high enough to support such growth of this relatively higher value item. Now, Scottish Oriental first invested in Blue Star in 2015. While the industry has been growing and has indeed accelerated in recent years, what we have seen with Blue Star is that every year they have gained market share. They've done this by consistently launching new products. For example, recently they've launched a more affordable line of air conditioners, which has increased the addressable market significantly, but by also consistently increasing their distribution as they go deeper into the tier 2, tier 3, and even tier 4 towns of India. So over the last 10 years, Blue Star's market share has increased from 5.5% to 13%. It's more than doubled. And in our view, there's a lot more gain in terms of market share to come because it remains a fragmented industry. Over the next 5-10 years, we expect the industry to consolidate among the market leaders and for Blue Star to be among the leaders driving this consolidation process. And finally, they've also entered new categories, which are adjacent to air conditioners, the likes of air coolers, air purifiers, and water purifiers. Each of these in the coming years can become independently large businesses for Blue Star as well. And the company, given the brand that it has already built in air conditioners, has a strong right to win in each of these categories. To give you a sense of the relative sizes, now Blue Star's market cap is about $1.7 billion. The market leaders in the air conditioning industry in China have a market cap of between $40 and $50 billion on average. So clearly this is a business which, as the industry grows and it continues to gain market share and enter adjacent categories, has the potential to become several times its current size. Now, moving on to give you a sense of how the portfolio is positioned today. Now, firstly, as I mentioned earlier, the portfolio construction bears no resemblance to the index. The country weights that you see here are entirely a residual outcome of where we are finding the most number of bottom-up opportunities. Now, typically, we find the most bottom-up opportunities in countries like India and Indonesia, rather than in North Asian markets like Taiwan or South Korea or even China. There are a couple of basic reasons for this. Now, firstly, as minority shareholders, we spend all our time trying to identify our alignment with the owners of the companies. We find many more privately owned businesses in markets like India and Indonesia. And because they're privately owned, we can have conversations with their owners around areas such as ESG or succession or return on capital employed. It's very different in the case of China or South Korea, where there are chaebols or where there are a number of state-owned enterprises which are dominant in those markets. In these countries, we don't know if these companies, these state-owned enterprises, really have shareholder interests at the top of their mind, or whether they are pursuing a much larger national service agenda, and where shareholder returns lie in that spectrum. Secondly, the market leaders in markets like India and Indonesia, they are still smaller companies. It is that the categories that they operate in are not large enough yet, but given the size of these markets with over 1 billion people in India and almost 300 million in Indonesia, they will become much bigger categories in the years to come as per capita incomes rise. We've already seen this process taking place in the North Asian markets like China or Korea. So the market leaders are already very large businesses, like the leaders in the air conditioning industry in China. And so what we are left with in the smaller company universe in these markets are companies that are either cyclical businesses, and we don't believe that we are experts at timing cycles, or they're businesses which have very small or marginal positions in their categories, or in some ways have been left behind. And those are not the businesses that we would like to invest behind either. So that is the reason why you see the country positioning of the portfolio as it is today. Now, what has all this meant in terms of portfolio outcomes over the long term? So if you were a shareholder of Scottish Oriental from inception, say if you had invested $1,000, that would have gone to about 18,000, £1,000. That would have gone to about 18,700 pounds today. The same investment made in the index, the MSCI Asia X Japan index, would have gone to slightly below 5,100 pounds today. So clearly it has been a relatively satisfactory outcome for shareholders. Now, what has happened in recent periods? Over the last year in particular, as you're well aware, it has been a fairly volatile period for markets. And it is in this period that we believe our focus on risk and our investment philosophy really comes to the fore. And we've seen that happen in this period as it has in previous down markets as well. So in a difficult period for markets, we've seen the trust conserve our shareholders' capital reasonably well. And moving on to how the portfolio is positioned today, I'll make a couple of points. Firstly, as you can see in terms of the top 10 and top 20 holdings, the portfolio has become much more consolidated among the top 10 and top 20 holdings. Now, this is a result of having much higher conviction in the top holdings of the trust. Secondly, the return on equity of the trust has consistently improved. As the companies have gained scale, they've gained market share over this period quite consistently, and they've used the operating leverage to improve their return on equity. Secondly, as the whole region, the various markets have come out of COVID, a period of great disruption, the earnings per share growth that we expect over the next couple of years for the portfolio is significantly higher than the past. Some of this is a base impact as well, clearly, given that the previous couple of years because of COVID were depressed. But as companies come out of this with higher market shares than they went into it with, we expect the market leaders in which we are invested to capture the majority or the largest share of the growth. And finally, even though the return on equity of the portfolio has improved and the return on equity of the portfolio has improved, the portfolio valuations are actually lower than they have been in recent years. So overall, the portfolio offers fairly attractive metrics. So where over 2 years, we expect earnings per share of the portfolio to grow at 21% per year, and for the portfolio to generate an average ROE of about 19%. And for that, this portfolio trades at 17 times, and the median net debt to equity of the portfolio is still at a net cash position. If this was a company, we'd find it reasonably attractive. And so we are quite excited about the prospects of the portfolio today. Now, I'll leave you with a summary. The investment philosophy of Scottish Oriental has stood the test of time, and it remains focused on capital preservation. The investment process is entirely bottom up in nature, and we focus on finding those smaller companies which have the potential to become the large companies of the future. Secondly, our entire time is spent on assessing downside rather than chasing upside. And it is in difficult periods as we are going through today that we expect our investment philosophy to come to the fore. And finally, the portfolio is currently positioned as a consolidated portfolio of high ROE businesses that are growing faster than they were in the past as they've gained market share, and the valuations which we find across most of our markets are actually fairly reasonable. So we see no reason why the track record that we've demonstrated in the last 2.5 decades can't be replicated in the years to come as well. Thank you very much. I'd be happy to take questions.
Thank you very much indeed for presenting this evening. First questions we have are about the portfolio. How small are the smaller companies? Do you have a market cap range that you operate in? So what's the bottom and what's the top?
Yes. So the mandate of the trust is that we define smaller companies as companies below $5 billion in market capitalization at the time of first investment. So what this means is that if after the first investment, the company exceeds $5 billion in market capitalization, we aren't forced sellers of that business. So we can continue to hold on to it or add to our position in those cases. In terms of what the lower limit is, there isn't a specified lower limit in terms of threshold, but naturally, given the size of the trust and liquidity constraints of businesses that are too small, typically we wouldn't own businesses that are below a couple of 100 million in market capitalization.
Is there an average size of company that you're invested in?
There are, yes. So the average size of the company in the portfolio would be closer to $1 billion.
And the next question I have is about portfolio turnover. I think it's two parts. When do you sell a business? And then also just a general comment about the turnover. Having that cautious approach, you have a lower turnover, less reasons to sell a business than maybe other trusts in your peer group might.
Yes. So typically when we take a view on a business, Roland, the view we take is for at least 5 years, if not much longer than that. There are a number of holdings in the portfolio, such as Vitasoy, which is based in Hong Kong, which is where I am currently, which have actually been held in the portfolio since inception. So we do tend to take a very long-term approach towards managing the portfolio. But at the same time, what we do is as I mentioned, we are careful about valuations. So while we remain invested with companies over the long term, there are times when we add or trim, depending on valuations and where we are finding more opportunities, and we use other ideas to fund those opportunities as well. In terms of when we would sell a company, so clearly the one thing that is sort of non-negotiable for us is the quality of governance. So if we ever find that from a governance perspective, something is done where minority shareholders or even other stakeholders are disadvantaged, then we wouldn't want to remain invested behind that business. That hasn't happened in recent years, but that is something that would be a clear reason for us to sell. But also secondly, it could be capital allocation decisions by management, where they may have taken on significant debt to buy something. We don't like leveraged balance sheets, for example, or made an acquisition at very expensive multiples for the sake of growth. Again, something that we don't like, just management chasing growth for growth's sake. So those could be reasons as well. So essentially it is where we feel that either the governance is changing or the return on capital of that business is changing in the times to come, or something may have changed in the industry. So we're always assessing those changes. That's the reason why we're always on the ground meeting companies to see how the operating environment of those businesses is changing, or are businesses really getting stronger, or are they actually getting weaker? So that's what informs our investment decisions. And in terms of valuations, we're careful about not overpaying for businesses. So we're continually adding where we're finding opportunities, or trimming where we think things have gone too expensive. But we tend to take a long-term view, and our time horizon is at least 5 years.
The next question is about valuations, and in particular in India. The question is saying Indian valuations look pretty high, and I think you showed about a third of the portfolio in India. Can you comment on your thoughts on valuations in India and how you approach that, please?
Yes, absolutely. So valuations in India at an optical level, Roland, are definitely high, and they have been for the last decade or so, actually. If you look at say India's premium to the MSCI Emerging Markets Index as an index, the Indian index, India trades currently at about a 55 to 60% premium to the average PE of the MSCI Emerging Market Index, and that has been roughly the median level of the premium of the Indian index in terms of PE compared to the last decade. So it is trading roughly around there. Some of the reasons why the Indian equity markets are more expensive is, firstly, as I mentioned, the alignment with minority shareholders, from a governance perspective, the comfort that we have, even from a regulatory perspective, the kind of comfort that minority shareholders have there, and that comfort has only improved over time. The quality of institutions has only improved over time. So that is one. Secondly, the growth potential that exists in India is definitely more attractive, especially among smaller companies, than we find in many other markets which are much more mature, and the growth isn't the same. Having said that, there are clearly certain pockets of the Indian market which are too expensive in our view. And as a result of that, we've actually stayed away from those pockets of the market. We'd say that actually this is quite similar to almost every market that is out there. So if you compare this to, say, solar or EV companies in China, we'd find those pockets of that market to be extremely overvalued as well. So we'll find similar pockets in India as well. We don't own such businesses in any of these markets that we operate in. What we own are high return on capital, simple to understand, steady businesses, and those are typically valued very reasonably. So most of our businesses in India would be valued at 20 times forward PE or below. There would be some exceptions to that, but we believe in those cases the potential growth in the coming years and the return on capital merits a premium. But generally speaking, our portfolios, given our focus on assessing downside, stays away from those companies which are valued at exorbitant levels today.
Lovely. Sree, we are then out of time. Thank you very much indeed. And again, you're in Hong Kong, so is 2:30 in the morning? Is that right?
Yes, it is.
Thank you so much for joining us. Thank you for presenting and introducing the trust to us. I really appreciate that.
Thank you, Roland. Thank you.